5 days ago, China made a move that most Americans have no idea happened. And by the end of this video, you'll understand exactly why it could cost you money in your mortgage, your groceries, and your retirement account before the end of this decade. On May 1st, 2026, China eliminated tariffs for 53 African nations simultaneously. Every product, every category, zero tariffs, no conditions attached. The European Union has never done this. The United States has never done this. Not once. Not for anyone. China just did it for an entire continent overnight. But here is what the headlines are completely missing. This is not a trade deal. This is a financial architecture designed to move an entire continent off the US dollar, and it launched 5 days ago. If you want to understand how a trade agreement in Africa ends up raising your mortgage rate in America, stay with me. This is the exact mechanism, step by step, and it is already in motion. Drop a comment right now. Do you think Africa shifting to the Chinese yuan permanently weakens the dollar? Or is it too early to matter? I read every single one. Before we go further, the numbers behind this story are staggering, and most financial coverage is getting them wrong. China-Africa trade hit a record $348 billion in 2025, up 17.7% from the year before. In just the first quarter of 2026 alone, before the full zero tariff rollout even landed, bilateral trade was already running at an annualized pace approaching $95 billion. That was before May 1st. Now, 20 additional middle-income African nations have entered the zero tariff zone, including Nigeria, Africa's largest economy, South Africa, its most industrialized, Egypt, which controls the Suez Canal, Algeria, which holds the continent's largest natural gas reserves, and Morocco, which supplies a significant share of the world's phosphates, the mineral that feeds global fertilizer production. These are not small economies on the margins. These are the economic engine rooms of an entire continent. And as of 5 days ago, every single one of them is trading inside China's preferential architecture, settling transactions through China's own payment system, CIPS, in yuan. Not dollars, not through SWIFT. Share this video with one person who still thinks China's Africa strategy has nothing to do with them, because the next 10 minutes will change that completely. Here is the 4-step sequence that turns a trade deal in Nairobi into a financial event in your neighborhood. Step 1. African exporters gain a real price advantage. A South African winemaker who previously paid 8 to 30% in Chinese tariffs now pays 0. A Kenyan coffee exporter, a Moroccan phosphate miner, a Nigerian petrochemical producer, all of them now competing inside the world's second-largest consumer market on dramatically better terms than any Western economy has ever offered them. Step 2. Trade volumes scale fast. China has been Africa's largest trading partner for 17 consecutive years. The relationship grew 27.5 times over in 25 years, from roughly $12 billion in the year 2000 to $348 billion in 2025. Zero tariffs pour jet fuel onto a fire that was already burning. Conservative projections now put China-Africa trade above $500 billion annually by 2028. Step 3. And this is the one Wall Street is not explaining clearly enough. As trade scales, settlement currency determines everything. China's payment system, CIPS, already connects 1,783 financial institutions across 189 countries and processes $24 trillion annually, growing at 43% year on year. When an African nation exports to China under zero tariff terms, the natural settlement currency is yuan. African exporters receive yuan. African governments hold yuan as working reserves. African central banks accumulate yuan instead of dollars. This is not speculation. It is the documented, stated policy effect confirmed by multiple institutional economic assessments of the rollout. Step 4. African central banks that accumulate yuan reduce their structural need to hold US dollars. And every dollar of reduced demand for dollars is one less dollar flowing into US Treasury bonds. When Treasury demand weakens, yields rise. When yields rise, mortgage rates rise. The 10-year Treasury yield and the American mortgage rate move together, and they have been moving in one direction while most people have been focused elsewhere. Now, here is where intellectual honesty matters. because credibility requires it. Of the $115.6 billion in goods Africa exported to China in 2024, approximately 94.5%, oil, copper, gold, cobalt, iron ore, already entered China duty-free under existing trade rules. The May 1st policy did not change their tariff status. What it changed specifically is processed agricultural goods, light manufacturing, textiles, food products, and chemicals, categories where tariffs previously ran between 8% and 30%. China is foregoing a few $100 million in annual customs revenue on those categories, while maintaining a $12 billion structural trade surplus with the continent. The policy costs China almost nothing economically. It gains China an enormous amount strategically. But here is why dismissing the dollar impact because most commodities were already zero tariff is the wrong conclusion. The dollar story is not about which goods change tariff rates. The dollar story is about the settlement infrastructure being constructed on top of a $348 billion trade relationship, and the direction that relationship is moving. Pan-African banking giant Ecobank, operating across 35 African markets, is in active talks with Bank of China to launch direct yuan settlement services by the end of 2026. Ecobank's CEO stated publicly that instead of routing through the dollar, they are looking to settle directly in yuan. Nigeria, South Africa, and Egypt are actively piloting yuan in domestic reserves and payment systems. Zambia now accepts yuan for tax payments. The African Export-Import Bank has explicitly recommended expanding yuan-denominated trade finance tools across member countries. And the African Development Bank is now formally tracking yuan adoption in reserve management for the first time in its annual fiscal outlook. These are not fringe experiments. These are the continent's most systemically important financial institutions building infrastructure that routes around the dollar, because their clients are demanding it. Here is the direct line to your household finances. The dollar's reserve status provides what economists call the exorbitant privilege, the ability for the United States to borrow at lower interest rates than any other country on earth, because global demand for dollars is structural. Foreign central banks accumulate dollars, buy treasury bonds, and that captive demand suppresses American borrowing costs. The Peterson Institute estimates this structural demand saves the U.S. government roughly $100 billion annually in interest costs, savings that flow through to lower mortgage rates and more affordable consumer credit across the entire economy. As African central banks accumulate yuan instead of dollars, driven by zero-tariff trade economics and CIPS settlement infrastructure, they reduce incremental treasury purchases. The structural demand base for U.S. debt narrows, and the United States needs to raise $11 trillion in 2026 alone, $2 trillion in new deficit financing, plus $9 trillion in maturing debt that needs to be rolled over, with Japan facing domestic pressure to repatriate capital. With China's official treasury holdings down 47% from their peak, with BRICS nations broadly reducing dollar exposure. And now with Africa systematically redirecting its trade settlement to yuan, the supply-demand equation for U.S. Treasuries is tightening from multiple directions at the same time. The IMF confirmed in its April 2026 fiscal monitor that the U.S. Treasury safety premium is measurably narrowing. That narrowing is already embedded in the 6.3% to 6.83% mortgage rate every American homebuyer faces right now. Africa holds 60% of the world's uncultivated arable land, 40% of global gold reserves, the majority of the world's cobalt and coltan, essential for electric vehicle batteries and advanced defense systems, critical deposits of manganese, chromium, platinum, and phosphate. A population of 1.4 billion today, projected to reach 2.5 billion by 2050, the youngest, fastest-growing demographic on Earth. In 10 to 15 years, Africa will be the world's most important marginal driver of commodity demand, manufactured goods consumption, and financial services growth. China is not competing for 2026 Africa. China is locking in the Africa of 2035 and 2045, and it is doing it with zero tariffs, yuan settlement rails, and a trade partnership that just had its most significant structural acceleration 5 days ago, while most of the American public was looking elsewhere. The petrodollar was built in 1974 on one commodity deal with one country. What China is building is an entire continent, 53 countries, 1.4 billion people, the world's most critical mineral deposits, and the most important long-term demographic story on Earth, progressively settling its trade outside the dollar system. The infrastructure launched May 1st. The compounding effect of that decision runs for decades. We track this story every single day, because by the time it makes the mainstream news cycle, the window to understand it ahead of the curve will already be closed. Drop a comment below. Tell me how many of those 53 African countries you can actually name without searching. That gap in awareness is precisely why this shift is happening, while most people are focused on something else. Share this with someone who needs to hear it. And if you want this level of analysis delivered to you before the headlines catch up, you already know what to do.